Hello and welcome back to The Note. We're going to talk about pensions today. Most people would say that this has been rather a quiet and flat year so far, but if you're managing a pension, it's actually been a very bad one. Now, last week I spoke to Ronald Ryan, the founder of ALM in Seattle, and I started by asking him, why is the funding gap for pensions actually widening? So, Mr. Ryan, let's start by taking a look at this chart, which shows that the funding gap for US pensions has widened considerably since the crisis. Explain to me what we're looking at in this chart and why it's happening.
This is a chart of assets versus liabilities in present value. And you can see that in the 90s, most pension funds had a surplus.
Is that because stock markets were booming?
That's right. The 20–30% returns a year were pretty normal. And then in 2000, the asset side began to get hurt due to the heavy skewness to equities. But what most people don't realize is because interest rates have trended downward since 1982, liability growth has been sensational. Because you discount at that rate, the lower rate you discount at, the higher the liabilities are. It's just like a bond. As interest rates go down, the price of a bond goes up. So liabilities have enjoyed, if you want to call it that, extreme present value growth of more than 10% a year during this period. And this year, higher. So this year, liability growth is most probably 10 to 20%, dependent on the duration of your liabilities. Well, that's quite a shocking number, particularly if public policy is to deliberately keep rates, long-term rates, low. One of the great salvations of pensions would be to have interest rates trend upward. And then we'd have low liability growth, hopefully negative liability growth, and that would be a great way to save the pensions, is have interest rates trend upward. Okay, but it's certainly obstinately not happening thus far. Now let's take a look at a specific example, which is the pension fund run by New York City for its employees. It's very difficult to actually get the numbers all onto the same charts, but as I understand it, their contribution has grown by a third every year for over a decade. Is that actually right? Correct. The pension problem, the pension crisis that we face in America and throughout the world is a cost crisis, a contribution cost crisis. If asset growth does not equal or exceed liability growth in dollars, you have to put up more money. It's called a contribution. Right. And here's an example of it, that NYSER's New York City Employee Retirement System had to increase its contribution cost from $68 million in 2010 to over $3 billion last year. And the numbers almost cease to have meaning when they're that great. Presumably we're not talking about resolving this crisis now, we're merely talking about mitigating it. What are your suggestions for how we can, starting from where we are now, for how we can mitigate what is obviously potentially a huge social problem? Well, first, just like a doctor, you have to do a diagnostic. Right. You have to install a custom liability index that is the proper benchmark for the asset side. Okay, so that's the liability, their actual liabilities based on the actual age of their pensioners. Correct. Right. The actuary calculates the future liability benefit schedule. What we do is calculate the present value, the market value of those liabilities, which tells you how those liabilities are growing, how they behave, the size, the shape. That's the first step. Right. Then we get to asset allocation that says, based upon the size and shape of these liabilities and the funded ratio, how bad is our deficit, we make a decision on how we do our asset allocation. If you have a large deficit, you're going to put more money into alpha assets or performance assets. Right, so take more of a risk, in other words. Correct. Right. If you have a fully funded plan, then you want to put most of your money in beta assets, whose job it is to match and fund the liabilities. So that's a dynamic. As the funded ratio improves, you can be shifting assets from risky or alpha assets to matching and funding assets, beta. And next is performance measurement. You need to monitor. I mean, surely they're doing that already, aren't they? It is rare, that performance measurement looks at assets versus liability growth.
They just look at asset growth.
Correct. It's an asset-only world out there. One of the problems. There should never be an investment committee meeting without liabilities being present. Unless you have a custom liability index, how are you going to know liability growth? How are you going to know your funded ratio?
Talking colloquially, it sounds to me as though you're saying that the pension system in this country and much of the rest of the Western world has been run for decades as though there's literally no tomorrow. Is that an exaggeration, or does it seem fair? They're really not taking into account their liabilities.
Given the wrong objective, you will get the wrong risk-reward behavior. The objective of most pensions has been a return objective, the ROA, return on asset assumption. It's rare that it's a liability objective. So they need to get themselves back on track. What's the true purpose and objective of a pension? Fund liabilities at stable costs, hopefully low costs. That's what it's all about.
Okay, Mr. Ryan, thank you very much indeed. Most of you will probably not have enjoyed that interview very much, but it's extremely important. We need to rediscover exactly what a pension is trying to do before we end up with lots of deserving people not getting the income they need in retirement. And obviously, it would also help very much indeed if interest rates did at last start moving upwards.